There's a piece of financial advice that has achieved something remarkable. It's recommended by academics, endorsed by Warren Buffett, repeated in virtually every personal finance book written in the last 30 years. And if you spend more than 10 minutes on any investing forum, someone will say it to you like they've just discovered fire. Just buy index funds. Low fees. Broad diversification. No stock picking. No fund managers. Just the market. It's the advice that finally feels like it has no catch. The humble, boring, mathematically sound choice. And for a long time, it was a contrarian idea. When John Bogle launched the first index fund at Vanguard in 1976 with $11 million, Wall Street called it Bogle's folly. Why would anyone voluntarily accept average returns? Turns out a lot of people would. Vanguard today manages over $8.5 trillion. BlackRock manages more than $11 trillion. Passive investing went from a fringe academic theory to the dominant force in global markets in roughly one generation. Which brings me to a question that almost nobody in personal finance wants to ask. What happens when everyone takes the same advice? Before we get into the concerns, it's worth making sure we're all working with the same understanding of what index funds actually are, because the concept is simpler than the financial industry sometimes makes it sound. When you invest in an actively managed fund, you're essentially hiring a professional, a fund manager, to pick stocks on your behalf. They research companies, make judgment calls, buy and sell based on their analysis. In exchange, they charge a fee, typically somewhere between 0.5% and 2% of your assets per year. That might sound small. On a $500,000 portfolio over 30 years, it can mean the difference of hundreds of thousands of dollars in compounded returns. An index fund does something fundamentally different. Instead of trying to pick winners, it simply tracks an existing market index, like the S&P 500, which is the 500 largest publicly traded companies in the United States. The fund buys every company in the index, weighted by size, no analysis, no judgment calls, no fund manager. If Apple is 3% of the S&P 500, the fund holds 3% Apple. When the composition of the index changes, the fund adjusts automatically. The pitch is straightforward. Instead of trying to beat the market, just be the market. And the data over time has largely supported that pitch. The majority of actively managed funds underperform their benchmark index over a 10-year period. Not because fund managers aren't smart, many of them are extremely smart, but because markets are competitive, fees compound against you, and consistently predicting which stocks will outperform is extraordinarily difficult even for professionals. So the math pointed one direction. And investors followed. In 2005, passive funds, index funds, and ETFs that simply track a market index rather than actively picking stocks made up less than 5% of equity assets under management. By 2019, that number had climbed to 45%, and it has continued to grow since. To put that in context, in less than 20 years, passive investing went from a footnote to nearly half of all equity fund assets. Now, this didn't happen by accident. It happened because the case for index funds is genuinely compelling. Study after study showed that the majority of actively managed funds underperform their benchmark index over a 10-year period, and those are the ones that survive. Many funds that underperform simply close and disappear from the data entirely, which makes the average active fund look better than it actually is. When you account for that, the performance gap gets even wider. So investors rationally started moving their money. Slowly at first, then all at once. And that rational individual decision, repeated by millions of people, has quietly created something that's worth paying attention to. Here's a concept that doesn't come up much in personal finance content, but it's foundational to how markets are supposed to work. It's called price discovery. The basic idea is this. In a functioning market, the price of a stock reflects the collective judgment of millions of investors who are analyzing companies, studying financials, assessing management, evaluating competitive positions, and deciding what a business is actually worth. When new information comes out, an earnings report, a product recall, a change in leadership, investors update their analysis and the price moves accordingly. That process, messy, imperfect, but ongoing, is what makes a stock price meaningful. It's what makes the market, in theory, a somewhat accurate reflection of underlying economic reality. Index funds don't do that. An index fund doesn't analyze anything. It doesn't ask whether a company is overvalued or undervalued. It buys everything in the index, in proportion to its market cap, no questions asked. If a company gets bigger, the index fund buys more of it. If it gets smaller, it buys less. The price is someone else's problem. Which is fine, as long as someone else is actually doing the work. In 2019, Michael Burry, the investor who famously predicted the collapse of the subprime mortgage market and was portrayed in The Big Short, made a provocative argument. He said that passive investing has removed price discovery from equity markets. That index fund models don't require the security-level analysis that true price discovery depends on. And he compared the passive investing boom to the CDO market before 2008, a financial product that grew so large, so fast, that the underlying risks became invisible until they weren't. His conclusion: the longer it goes on, the worse the eventual correction will be. It's worth taking that seriously. Burry has a track record that earns him a hearing. It's also worth noting that he made that call in 2019. The S&P 500 has returned roughly 80% since then. The crash he anticipated has not materialized, at least not in any way that's been clearly linked to index fund mechanics. Which doesn't mean he's wrong. It means he might be early. And as the old saying goes, the market can remain irrational longer than you can remain solvent. A structural imbalance can build quietly for years before it resolves. Sometimes violently. The subprime mortgage market looked fine right up until it didn't. That's the nature of the risk Burry is describing. Not that the system is broken today, but that the conditions for instability are accumulating in ways that won't be obvious until they are. Whether that's prescient or paranoid is genuinely unclear. Both are possible. But here's where it gets interesting, because the counterargument is also pretty strong. Index fund trading, despite the enormous assets under management, accounts for only an estimated 1 to 5% of actual daily trading activity. The prices you see on your screen are still largely being set by high-frequency traders, hedge funds, institutional active managers, and individual investors making active decisions. The people who actually move prices on a minute-to-minute basis are not index funds. And there's a logical test you can apply here. If index funds were truly distorting prices and making markets less efficient, active managers, the ones doing all that fundamental analysis, should be finding it easier to beat the market. Inefficient markets are where skilled stock pickers are supposed to thrive. That hasn't happened. Active fund underperformance has not improved as indexing has grown. One more thing worth noting. The voices most loudly warning you about the dangers of index fund popularity tend to belong to people who run actively managed funds and charge 1 to 2% a year for the privilege. That doesn't make them wrong, but it's the kind of incentive worth keeping in mind when you're evaluating the argument. Here's the part most personal finance content never gets to. The price discovery debate has been around for a while. Smart people disagree. The evidence is genuinely mixed. But there's a second consequence of index fund dominance that doesn't get nearly enough attention, and it's less about your returns and more about something larger. BlackRock, Vanguard, and State Street, sometimes called the Big Three, are now the largest shareholder in 88% of S&P 500 companies. Together, these three firms control roughly 25% of the stock of every major public company in the United States. Let that land for a second. 3 asset management companies are the dominant owners of American corporate America. And here's the part that most individual investors don't think about. When you own shares, you have voting rights. Shareholders vote on board members, executive compensation, mergers, environmental policies, corporate governance. These votes matter. They shape how companies are run. When you buy an index fund, you're not exercising those votes yourself. You're handing them to the fund manager. And BlackRock, Vanguard, and State Street collectively vote those proxies on behalf of tens of millions of investors, most of whom have no idea this is happening. Research shows these firms vote with management in roughly 90% of shareholder votes and tend to vote against shareholder-sponsored proposals. Whether that's good or bad is a separate debate. The point is that a small number of enormous institutions are making governance decisions on behalf of a massive portion of the investing public, quietly, routinely, and largely without scrutiny. This isn't a conspiracy theory, it's just math. When passive ownership becomes this concentrated, the corporate governance implications are real regardless of how you feel about any particular firm's politics or priorities. Some academics have raised an even broader question. Is this level of common ownership healthy for competition? If BlackRock owns large stakes in every major airline, every major bank, every major pharmaceutical company, does that create subtle pressure against aggressive competition between those companies? The research on this is contested and ongoing. But the question itself is legitimate. There's something almost poetic about where we've ended up. Index funds were invented as the antidote to Wall Street. The explicit promise was democratization, low fees, no fund managers skimming returns, no conflicts of interest, no pinstripe suit standing between you and your retirement. John Bogle didn't just create a financial product, he framed it as a moral stance. The little guy finally had a weapon. And in many ways, it delivered. Millions of people have built real wealth through index funds who would have been quietly drained by expensive, underperforming, actively managed funds a generation ago. The fee savings alone, compounded over decades, represented genuine transfer of wealth back to ordinary investors. That's not nothing. That's actually significant. But zoom out and look at the aggregate picture. The collective result of millions of people making that individually rational anti-establishment choice is that three of the largest financial institutions ever assembled now effectively co-own American corporate America. BlackRock and Vanguard alone account for nearly 60% of the entire equity ETF market. The little guy's financial weapon became the greatest concentration of corporate ownership in modern history. Nobody engineered that outcome. No one sat in a room and planned it. It emerged organically from good advice, taken seriously by enough people at the same time. And there's something almost darkly funny about that. The rebellion against Wall Street that ended up creating something Wall Street itself never managed to build. The irony isn't that index funds failed. It's that they succeeded so completely that the success created its own entirely new set of questions. Before we land this, let me be clear about what I'm not saying. I'm not saying index funds are bad. I'm not saying you should switch to active management. The data on active fund underperformance is real and consistent. The fee advantage of index funds is real and it compounds. For the individual investor making decisions today, the case for low-cost passive investing is still strong. What I'm saying is that there's a difference between your financial decision and the systemic question of what happens when virtually everyone makes the same one. Personal finance content almost always focuses on the first question. It rarely asks the second. And the second question doesn't have a clean answer yet. The market distortion thesis Burry raised in 2019 hasn't played out the way he suggested, at least not visibly. Not yet. The concentration concerns are documented and real, but their long-term consequences are genuinely unclear. These are open questions being debated by serious economists and regulators. You're allowed to hold both things at once. Index funds are probably still the right choice for most people, and the system-wide implications of their dominance deserve more attention than they get. Index funds might be the single smartest individual financial decision available to the average investor. They might also be a collective experiment. One that's been running for less than 50 years, that has never been tested at this scale, and whose full consequences we won't understand until something goes wrong. Or maybe nothing goes wrong, maybe the market adapts, maybe the concerns are overstated. What I'd push back on is the idea that the conversation is over, that index funds are simply correct, end of story, no further questions. Because the most interesting financial questions are usually the ones that feel settled. Burry made his call in 2019, and the market has returned 80% since. So the question I'll leave you with is this. Is he wrong? Or is he just early? Drop your take below.